common terminology. You have an understanding of what the stock market is now, and you see how you can either make or lose money doing this. So now you just go over common terminology. So nothing is unfamiliar when I start teaching more advanced concepts. So when you take a trade occurs when a buyer and seller come to an agreement and exchange one thing of value for another. So I got this water in my hand. Let's say you got a pencil and I need the pencil, but I have water and you want water. So I give you this pencil, I give you this water, you give me a pencil. That's a trade because I gave you something of value for something of value. And in this case, a buyer would trade his money for shares in a stock, and a seller would trade their shares of stock for money. And then that's a trade. That's a single trade right there. And profit, that's how much money you make by selling your stock for more than what you paid it for. And the common saying, buy low, sell high. Loss is self-explanatory. It's what you lose. Money you make, the money you make, well, you don't make it, but money you lose selling a stock for less than what you paid for it. Day trading, buying and selling a stock or an option in the same trading day. Whether you buy and sell within 5 minutes, 5 hours, that's a day trade because you sold it within that day. And the stock market opens 9:30 a.m. Monday through Friday, except for holidays, and closes at 4 p.m. So if I take a trade 9:31, sell it 2 p.m., that's a day trade. Swing trading, that's buying and selling stocks or options over an extended period of time in a period of like 2 or more days. So buy it today, sell tomorrow. Buy it one today, sell it in a week. Buy today, sell it in 3 months. It's considered a swing trade or like short-term investment. Scalping, that's honestly gonna be the kind of style that I'm teaching you in this. Scalping and day trading. Scalping is technically still day trading. It is day trading. Just the only difference is within a faster time frame. So you're anywhere from 30 seconds, 15 minutes, 20 minutes. That's a scalp trade because you're in and out. Like you're very quick with your executions, and you have to be really specific with like your time, the timing of your entry, and when you choose to buy, when you choose to sell, all that stuff. And excuse me, the goal of scalping is to capitalize on short-term price changes. Investing, long-term form of trading to build wealth over time. So you're buying something, holding it for like 6 months to a year, longer, 5, 10 years, and you're building a portfolio. Like you're buying something to hold so it could really gain value. You're not planning to sell it. You're gonna hold through all the, ups and downs, and yeah, like I said, ranges between years and decades before realizing any profits at all. And then these are terms to describe like the different states in the market and different actions in the market. So you have bullish, a term used to describe an opinion that the stock or the stock market will increase in value or go up. Bearish, the term that's used to describe an opinion that the stock or the stock market will decrease in value. So bullish up, bearish down. Going long or long is a term used to describe taking a bullish trade or opening a bullish position in the stock market. Example, I'm opening a long position on Apple, meaning I'm buying Apple shares or Apple options, whatever, and I want to sell it for more money. So a short is a different way to take a trade, and I just put it here because it's something that you still should be aware of. Like I'm opening a short position on the market, and you're gonna take a bearish trade on a stock because you think it's gonna decrease in value. So you're pretty much taking a bet that stock is gonna go down, and you can do that. Um, and the way it works is pretty much like you sell the stock first, and then you try to buy it when it's cheaper, and then you have to pretty much give the stock back. So it's like you're borrowing stocks, you sell it, buy the stock back at a cheaper price, and then you keep the difference. I'm not teaching you that here because what we're going to be doing is buying and selling. I mean, buying options and going long on different types of options, um, for the idea that they're going to increase in value. So don't worry about shorts. This isn't that important, but you still need to know what it is. Market cap, very important. It's short form for market capitalization, and it refers to the total value of a company listed on the stock market. And I need you to pay attention to this right here because this breaks down like what market cap, like how you get a market cap. So You get this number by multiplying the price of one share by the total amount of shares that the company issued and that's available in the stock market. So, the example I have here, stock XYZ, let's just say Tesla costs $4 a share. And then the company issued 1 billion shares in the stock market for the public, for investors, for market participants to actually trade. So that means the market cap is $4 billion. And that's technically what the company is worth. Like, and all the information is available, so you're never gonna have to calculate it yourself, but you gotta understand where it comes from, how it works, and why it exists. So small cap, that refers to stocks with a market cap between 300 million and 2 billion. Mid cap used to refer to stocks with a market cap between 2 billion and 10 billion. Large cap, anything 10 plus billion or plus 10 billion. So Apple, at the time of writing this, it had a market cap worth almost 3 trillion. I'm pretty sure it's above 3 trillion right now on date is 2/18/2024. Sure, it's over a trillion, 3 trillion now. But yeah, and then more terminology. You got bid taking a bid. That's pretty much describes somebody that wants to, like, the action of buying a stock. So you place a bid, and that's the highest price a participant that wants to buy a stock or an option is willing to pay at the moment. And the ask is the lowest price that a market participant who wants to sell a stock or an option is currently willing to let it go for. Spread, that's the difference between the bid and the ask. So, like, say again, Tesla, they're selling stock, right? And remember, I always talk about how the stock market is an option, and it is an auction. Stock market is an auction. So somebody's bidding to buy stock or buy shares of Tesla at $3, and the person who's selling it or the participant selling it is asking for $4 in order to give you that share that you want. So the spread between that would be $1 because the bid is at $3 and the ask is at $4. So the spread is $1, and there's different applications and like different reasons why that happens. And in order for a trade to work, pretty much by the bid and the ask, like they have to come to an agreement, or somebody has to choose which one they want to actually accept. And yeah, ticker, symbol that abbreviates the name of a company. We already went over that. And then volume, this is another really important thing because in the last video I talked about volume and price action, so pay attention to what volume is. And volume is the total amount of shares traded in a given stock in a specific time frame. So this could be any time frame. It could be a minute, a second, a day, a week, a month. That's the total amount of shares traded within that time frame. So for this example, I have 100,000 shares were traded in 15 minutes. So that means the 15-minute volume is 100K total shares traded. That doesn't mean that's 100K total shares traded in the day. That's just in the span of 15 minutes. And volume is the key things that all professional, like profitable, successful traders look at when doing analysis and when making trading decisions, because the more volume means more people are participating, means just more money, really, at the core. And volatility, that's the rate of change in a stock in a given time period. So that's like how quickly the price changes within a time period. So like say the average price, it could be like $3-4, but it could be volatile, so it might go up to $6, then $2, then $1, then the price will move around because again it's an auction. That just shows how volatile it is because it's just the rate of change in a given stock in a given time period. So like say you're trading the stock, you're day trading a stock, so it could be volatile within the day and it could move within a range of like $4 or $5. So it could go from like 105 to 110, 115. But say you come out of that time frame and you jump into like the daily time frame, it might not be that volatile, because it's just relative to the time frame and the volume. So Again, higher volume equals higher volatility, but it depends on the time frame you're in. And obviously, we'll go more into that later. You'll understand the concept as we go through the course, but that's what volatility is, just the rate of change. Um, yeah, so I say if you haven't noticed that, all these concepts do build off of each other, and they will get more and more complex. So do the best you can to follow along. This course is recorded, so you can always go back. You have the ebook, so you can always go back and restudy. And obviously, you have other resources too, like YouTube. So just make sure you're paying attention and you actually understand everything that I'm teaching you, because I really did curate and like pick out the specific things that I think that you needed. Not even think, I know you'll need in order to be profitable. So that being said, yeah, let's move on.